Christine Lagarde calling the coronavirus a major shock to the European economy and announcing a three-point plan to deal with it that does not include cutting interest rates. I believe we have some sound from what Christine Lagarde said earlier today.
We decided on a comprehensive package of monetary policy measures. Together with the substantial monetary policy stimulus already in place, these measures will support liquidity and funding conditions for households, businesses and banks, and will help to preserve the smooth provision of credit to the real economy.
So let's look at what the plan is. First thing, she kept rates unchanged. Get back to that in a second. They added to the long-term refinancing operations. They provided more favorable terms for a third round of targeted long-term refinancing operations. That's going to happen next year. And they added another 120 billion euro of new asset purchases or quantitative easing. Like other monetary policy officials, she called for a very strong fiscal response and then took several questions on why they didn't go negative, didn't precisely answer the question, said if we need to cut rates, we will. But then when asked about why she didn't cut rates further into negative, which was expected, I think, by at least many in the market, she said, we believe we have the most efficient, best targeted, the most focused set of tools to address the kind of risk we're facing under the current circumstances. I'm getting the feeling here, guys, that Lagarde is not a big fan of negative rates. We don't know that for sure, but certainly this particular response suggests that she'd like to avoid going further into negative territory in these circumstances. David?
Steve, thanks for that. Listen, Steve, I don't mean to throw another thing at you, but obviously the last hour we talked a lot about what response we may see from our policymakers and the Federal Reserve. Is there anything you're hearing from your reporting and or your expectation in terms of what we might hear today, if anything, from the Fed?
Not from my reporting. My suspicion is that, well, first of all, it was maybe a little overlooked yesterday. I guess the market overlooked it. The New York Fed came in yesterday, David, with, I don't know, a boatload seems like an understatement to me. By my count, it was $175 billion of extra liquidity into the system. I think they want to see how that helps or does not the functioning of the bond market. I'll be doing some reporting on that later this morning. As you know, we reported as early as Monday that there was some big gaps in the bid-ask spread that was not usual for the Treasury market with the huge declines in yields. The idea of the Federal Reserve coming in and taking some of the risk in the economy, that is possible. I heard you and Jim Cramer talking about that earlier. However, that would have to be done with the approval and in concert with the Treasury Department. They amended the Emergency Clause in the Federal Reserve Act that required the Fed to take those sort of actions only with Treasury approval. So we'll see if that happens. It is possible, probably likely, that Powell and Mnuchin are talking about some kind of response, but I've not heard anything yet at this point.
So, Steve, all week long, people have been trying to postulate positive narrative. What if Powell were to come out and even academically support what Rosengren had talked about last Friday? Does that seem to you in the realm of the possible?
I don't think so, Carl. What Rosengren was talking about was first you got to get to zero, and then this was his formulation here. Then you have to have a recession, and then the Fed should think about coming in to buy additional assets. In other words, other than stocks and government-backed and agency-backed mortgage bonds, for example, stocks or corporate bonds. But that would require, I think, a change in the Federal Reserve Act. Certainly, it would require approval of Congress, and it would only be done, approval of the Treasury. It would only be done to avoid negative rates. I think the Fed is far from that at this point. There are other administrative measures it can do. One thing they did in Europe that I haven't ruled out here in the States is to lower certain liquidity ratios for the banks. In other words, require them to hold less capital. And that is something we might see here in the States. There's stuff they can do with the discount window. There's additional quantitative easing. I would not be holding my breath for the Federal Reserve to come in and buy stocks. And I heard what Jimmy was saying about the idea of guaranteeing long-term, letters of credit. But I think the Fed is far from that. I would look first, guys, for the Federal Reserve to begin dusting off some of the financial crisis era programs that guaranteed liquidity in certain markets, for example, money markets and commercial paper. Before it got to any of that stuff, I think what we've seen here is that Powell wants to operate in steps and not necessarily, to shoot several bazookas at once here.
Yeah, a really good way to understand it, Steve.